Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to help you use macro to invest in markets. To see our latest thoughts and analysis on the world, visit macrohive.com. We've had a lot of interest in our research on house prices. So this week we published a piece on US house prices by region. And it looks like Idaho, Arizona, and Utah are seeing big price increases, while New York is not doing as well. We also had a great piece by previous podcast guest John Turek on why the RBA could be setting the template for the Fed in terms of keeping policy loose, even with a recovering economy. Other pieces you may like are which sectors are doing okay in the US labor market, whether politics will hurt Russian markets, and academic work on do founding partners matter for startups. All of these pieces are featured on the Macro Hive site. So if you're not already a member of Macro Hive, I'd urge you to sign up at macrohive.com. Your first month is free, and then it's only the cost of a few weekly cappuccinos, and many call Macro Hive the hidden gem for investors, so it's well worth it. Once again, sign up for a free trial at macrohive.com. On to my guest for this episode, we have Jay Pelosky. He's the founder of TPW Advisory, and he's formerly the top-ranked head of asset allocation at Morgan Stanley. We have a wide-ranging discussion, so I'm sure you'll enjoy it. So on to our conversation. Okay, welcome, Jay, to our podcast. It's great to have you on. And, I guess the first thing I like to do with all my guests is I like to ask a bit about their background. So I know you've been in the industry for a while, you've had lots of different roles, but how did you end up where you are right now? Like out of college, did you know you wanted to obsess about financial markets and investments and how to help clients make money? Was that what you wanted to do?
Well, it's funny you ask, Bilal, because I do have kind of a long and varied career, lots of different turns and corners. I did not know that that's what I wanted to do. I was a poli-sci undergrad major and a scholarship football player, American football, at college. And then I went and got a master's in international affairs at the George Washington University in DC. And I was told I needed to get some financial experience. I could write, I was published, etc., but I needed some financial experience. And so my plan was to go to New York for a year, go through a bank training program, get that experience, and then go from there. And that was now, jeepers, 35 plus years ago. So I met a girl from Brooklyn and married her. And once that happens, you're not leaving New York.
Where are you from originally? Where's your home state or your hometown?
I'm from Massachusetts originally and went to school at Duke University in North Carolina and then George Washington. So moving my way back north, but this is New York's as far as I've gotten. And, in this time with the pandemic, et cetera, I'm very much a New York City strong kind of guy and a big believer in the city and raising two kids here. So no plans to leave. But my experience, I've 30 plus years, I've done business in over 50 countries, been on both the buy side and the sell side. I started out non-Japan Asia and then was hired by Barton Biggs at Morgan Stanley Asset Management in 1990. And the first thing he told me to do was to go start a Brazil fund. So it's kind of like the hubris of the investment banks, right? I didn't speak Portuguese. I had no Latin American experience. I was a non-Japan Asia guy and said, no, you can go ahead and do it. And it was a great lesson because if you go back and look, Brazil in dollar terms, 1990 was literally the bottom for the Brazilian equity market. But Morgan Stanley and an arm of the World Bank could not raise any money. So a great lesson on how the time to invest is not always the time to market and vice versa. But we were able to get it done and spent 4 or 5 years doing Latin America, first on the buy side, then was asked to move to the sell side of the firm and start Latin American equity research. Then I started Global Emerging Market Strategy product, the first multi-regional, multi-asset research product for Morgan Stanley, right in time for the Asian financial crisis. And then Global Equity. And my last role there was the head of global asset allocation, which I did for several years and left the firm in 2002, started a family, did some philanthropy work and managed my own capital using ETFs. So I've been a big believer in ETFs, almost 20 years of personal investing history. I find them to be great vehicles for thematic global macro investing and just continuing to get better with the proliferation of instruments and the collapse in the cost of those instruments. So to bring us towards the present, over the last 10 years or so, I've been managing my own capital. I've served as an advisor. I've had a consulting firm for a number of years, advising institutions on asset allocation. And then 2-3 years ago, I started TPW Tripolar World Investment Management, really leveraging this tripolar world thesis I've been developing over the last decade, using ETFs to express a global multi-asset view. Now, sadly, notwithstanding good performance and decent visibility, that business, we were not able to kind of grow the AUM to the point where it would be profitable for us. So I've closed that business and now launching 2021 TPW Advisory. So sticking with the tripolar world theme, everything I see tells me that that process is continuing to unfold, but using it to provide advisory services, a unique and differentiated way to think about global macro through asset allocation and portfolio strategy advice, white label research. And the thing that I'm really excited about and is different is the model portfolio delivery using ETF-based model portfolios to kind of really leverage that tripolar world thinking and that thematic outlook, which I think is critical in today's markets. So long-winded answer, but it's been a long and winding road.
Yeah, well, that's great. Yeah, I didn't know you worked with Barton Biggs. I remember years ago reading his book, Hedgehogging, which has some really good anecdotes in there.
Yes, Barton was a unique guy. And, that time at Morgan Stanley, the macro team there, Steve Roach, Byron Lee, Barton Biggs, and others was really a great place to work. And Barton hired me directly at MSAM, and then I worked with him as a global equity strategist with him. He was the global equity strategist, but we had no product. And I was tasked with creating the product. And then, of course, worked with all those guys in the asset allocation side. So it was great training. And they were iconoclastic figures who thought independently. And I've tried to at least carry that independent thinking piece forward.
Yeah, no, that's great. Yeah, we've had Stephen Roach as a guest actually last year. We had him as a guest. He always had some big views as well, so he's still going at it.
At that point, I can tell you, and you ran research, you know what I'm talking about. To get on the Monday morning at Morgan Stanley, it was the Monday morning macro call. That's when the strategy and economics people had the floor for the sales forces, and you had to have something to say to get on that dais with Barton, Byron, Roach, many other really top-notch macro thinkers.
Yeah, and you mentioned the tripolar world. Maybe we can start with that. So what do you mean by the tripolar world? I mean, there's a thesis behind that, presumably, and that kind of is your framework in some ways or sets the scene. So maybe you can start with elaborating on that.
Yeah, I'd love to, because I think it's something that I'm proud of. It's my own intellectual property. I started developing it 10 plus years ago. Kind of an outgrowth to the great financial crisis, when all the policy response was monetary policy, unelected officials, no government really driven policy, no fiscal approach. And I felt like that was insufficient, and that globalization as we knew it was dead, was kind of killed by 2008, right? Finance, which we know well, was the tip of the spear. You worked in Asia for a while, so finance was really the driver to globalization. And once 2008 happened, that spear was broken. And subsequent to that, obviously, Brexit, President Trump, et cetera, things like that. Globalization as we knew it in the 2000s is dead. And nationalism, America first, et cetera, is unlikely, in my view, to be successful in the current age and in the future we're going into. So to me, it meant that the global kind of setup, global economic market, et cetera, was going to be almost a step back to regional integration, regional deepening in the three main poles of Asia, Europe, and the Americas. And so that's the tripolar, Europe, Asia, the Americas. And at the time, I focused on three drivers to that. Each region's growing ability to self-finance. So you think about the explosion of the Asian capital markets in the last decade. Each region's growing ability to self-produce. You think about mass manufacturing, mass customization, robotics, 3D printing, et cetera. And each region's growing ability to self-consume. Think about the rise of urbanization, service sector economy, and of course, e-commerce. And so that has been the framework that I've been working off of for a decade. And last year, the beginning of 2020, I added two new drivers. Each region's growing ability to self-innovate. So thinking here about technology and the splinter net with the tech sector separating between US and China, representing the Americas and Asia, with Europe kind of in the middle. And then each region's growing ability to self-protect to incorporate climate. Again, at that time, the US was not in the Paris Accord, so there's no global approach. Can't protect yourself individually as a country, but regional integration in the climate process, particularly in Europe with the Green Deal and the Joint Recovery Fund and the integration of those two really makes sense there. So for me, it's the tripolar world is our framework. And then we drop down to what I call the global risk nexus, which allows us to look at economics, politics, policy, and markets in each of the three regions and globally. And that has been an absolute wonderful thing to have over the last 5 or 6 years, which is the time period I've been developing it, because it really helps you keep everything in kind of in line and consistent, which is, we've gone through an age where the macro side has just been from, ping-ponging from one issue to the next. And so as an example of this, last spring, roughly a year ago, I added a fifth piece to that global risk nexus, which was health and to deal with COVID. And that gave us great insight into what I call COVID speed, which is something that we've been using and I've been using to kind of think about markets since the spring, the speed of the spread, the speed of the policy response, the speed of the market reaction, the speed of science with the vaccination, and the speed of delivery. Now, that last one with the has been disappointing in terms of the rolling out of the vaccination process. But outside of that, speed has been the thing that people have struggled with, right? Investors and market participants have been kind of behind the curve consistently since the spring. And so to me, my argument now is extending COVID speed and saying, look, that was the model of global capital, financial capital, and global intellectual capital focused on a single issue, sped up the vaccination process by a tenfold factor. It used to take 10 years. It took less than a year. And so my thinking is now that COVID speed is going to break out into things like climate, cyber, fintech, crypto, et cetera, these areas, these big issues. We've now seen the model. And I think that helps explain a lot of the action in financial markets over the last couple of months, as well as over the last year. But to me, it's a great example of how the tripolar world framework and the global risk nexus allows me to hone in as a macro guy on key issues with a framework and then communicate and invest accordingly.
Yeah, no, I can see where you're coming from. And I think it's really useful to have a framework. And as you say, if you don't have that kind of framework, then you will just bounce around from issues day to day almost, and you'll just be trading the price, the ticker, and nothing else then.
Certainly that's the risk. And I think, again, being a global macro multi-asset person, for the last decade hasn't really been the place to be, right? One of the struggles with TPW was that here in the States, people only cared about the S&P. And why not? The S&P was the best game in town for the last decade. But now I would argue that that's changing. And therefore, having a global multi-asset perspective and thematic perspective is going to prove very beneficial to returns over the coming decade. And so if you don't have a framework, it's almost inconsistent with the idea that you can be successful in the marketplace of the present and the future.
And maybe we can start with some of the big market topics. One big one obviously has been that equities are overvalued. We're in a bubble, and people sort of point to all sorts of different things, whether it's valuations of certain tech companies or innovative companies. They talk about the decoupling between the real economy and what markets are doing, something like that. How do you look at that? And then also, how does that map back to your framework then?
Yeah, I think we do have in the market section of the global risk nexus, we look at valuation, things of that nature as part of that process. Again, that check on making sure that we're thinking through things correctly. But I don't really see valuation as being a big problem. The way I'm thinking about things, I guess there's a couple of different ways we can attack that question. I'd start by saying my view is that we're approaching a global economic boom. We're going to have the best 2-year growth period, 2021 and 2022, that we've had in probably 50 years. 50 years. So which basically means that virtually no one investing today has ever experienced the environment we're going into, which I think is a key point to keep in mind.
No, that's a very good point. I mean, do you think that's a non-consensus view, or do you think that is a consensus view or not?
I think there's a consensus that we're going to have a recovery. IMF came out, just increased their growth estimates for this year and next, but they're at about 5%. I'm kind of more in the framework of my old firm, Morgan Stanley, which is calling for 6.5% global GDP growth in 2021 and roughly 5% in 2022. And those are the numbers that have not been seen since the 70s, and literally the early to mid 1970s. So that global economic boom, where I think the consensus is wrong on this is, interestingly enough, on the fixed income side, right? Because the consensus for Bloomberg consensus for the 10-year Treasury at the end of 2021 is roughly 1.2 to 1.3%. And that was consensus. I mean, again, I'm sure like you, I read a lot of 2021 Outlook pieces over the last couple of months. And that was the consensus, or the most shared, wildly off the mark outlook, in my view. My view is that we're going to see the 10-year at 1.75 or closer to 2 by the end of this year. And so we can talk about inflation and all the other things, but to get back to the point, global economic boom equals a great rotation, or leads to a great rotation in all sorts of things, from US to non-US equity, from growth to value, large cap to small cap, from FAANGs to innovation, from a bond bull market to a bear market. Again, same thing below. No one investing in the fixed income space today, virtually, has ever experienced anything but a bull market, right? Because the Treasury bull market began in the early 1980s. And yeah, there have been some blips and back and forth, but I'm very much of the view that we are in a bear market in US government debt, particularly long duration debt. And I also think that's not fully shared or fully positioned for. And that boom to rotation leads to what I call a golden age for asset allocation. And that golden age of asset allocation includes, importantly, the thematic approach. Because I think thematics are going to be critical, as I was talking about earlier with COVID speed breaking out into climate. You see the same thing, unparalleled amounts of financial capital plus intellectual capital focused solely on dealing with the climate issue. So when you see people talk about, and this gets to your valuation point, Tesla or, clean energy or batteries as being crazy in a bubble. And I think that's exactly wrong. That is completely wrong. The way to think about it is the world is seeing the movie of the COVID speed and the vaccine, knows it's going to be replicated, because once we've seen it, we're learning creatures. Once we've seen it, we're going to see the replication of it. And it's a problem of too much money trying to get into too few instruments. And that helps explain the IPO boom. January's IPO market in the US, best in a decade. Helps explain the SPAC boom, right? The blank check companies. Because that is financial engineering providing exposure, early exposure, to these areas that are of great interest, like electric vehicles, like batteries. All these companies are now coming public because, BLNK, which is the charging station company in the United States, if you wanted to play, if you believed that electric vehicles in the next decade were going to be roughly 50% of US new vehicle sales, and there's only one company that you can own that has the charging station business, how can you tell me what the right price is for that? So it's not meant to be modeled on a 1 year or 2 year cash flow basis. That's not it. So to me, the last point on this, and then I'll stop, is the idea of 60-40. With, over the last decade, 60-40 in the US, 60 S&P, 40 Barclays Ag, returned 10% per annum without doing virtually anything. And that was a gift. And guess what? Gifts go away. And that gift is gone away. So the 10-year, 5-year, 7-year forward look for 60-40 returns is much closer to 1% to 2%. GMO, KKR, one of the other great guys at Morgan Stanley was Henry McVeigh, who's now the head strategist at KKR. He's come out with his 10-year forward. AQR has come out with their 10-year 60-40. All of them are around 1% to 2%. And I don't think that this has penetrated the pension fund space fully, the endowment space, all the folks who pen risk parity, all the kind of knockoffs to this approach are going to struggle deeply in what I call a less generous beta world, which means you're going to have to work harder to find the alpha. And the alpha is going to be found in this great rotation and thematics. And so for the last couple of months, I've spent the bulk of my time trying to figure out how to incorporate thematics into my portfolios. And as I mentioned with TPW Advisory, we have a model portfolio delivery service. And this has been where I've been spending almost all my time. How much of these thematics into your typical global multi-asset portfolio, which ones, which ETFs, what weights? If you're going to add Bitcoin or crypto, what's the weight of that? It's super volatile. JP Morgan, 4 times more volatile over the last 5 years than equities. So you've got to size these things properly. That's what's exciting. That's what's cutting edge. That's, in my view, kind of the way people need to be thinking about.
And so if we take one of the themes that you mentioned, say climate change and this move to clean energy, so how would you express that as an investment?
Well, I think there are a number of ways to think about it. I think you have the clear, one way from the very top is the idea that in the last 6 months, roughly 60 to 70% of the global GDP has committed to net zero by 2050. Okay, so China, South Korea, Japan, and the United States, all in the last 6 months have committed to net zero. That's the idea that it's a global issue, right? That's the underpinning for the idea that there's going to be lots of money made available. And that is the idea that you're going to have this global intellectual pool, not just in the US, not just in China, not just in Europe, but all of these places. Folks, the smartest people are going to be focused on bringing these issues to the forefront. And so that then says it's a big theme. I need to incorporate it into my portfolio. Does it mean I sell? And here's kind of the interesting little tidbit right now. Does it mean that I sell all my old energy, my XLE for, let's say, US energy oil companies, the majors, and just buy clean energy like an ICLN, right? The International Clean Energy ETF? The funny thing is that the answer to that question is no. What you want to do right now is own both, because you can make money in both, and you are making money in both. And the portfolios that I'm responsible for have been doing very well, holding both XLE and ICLN.
And what's the rationale for still holding XLE then, the old energy?
Well, because we're going into this global economic boom. We've had a shortfall of investment CapEx in that oil and gas space because we've had, near-death experience. Remember, a year ago, the price went negative. It went negative. Talk about crazy. So the point is that we're going to have a boom. We've underinvested. We still are a vast majority hydrocarbon global economy. We're going to continue to be such for a period of time. And so you have respected firms like JP Morgan calling for a $70 a barrel Brent by the end of this year. $70. It's at 55 today, okay? And guess what? We talked about how treasuries are in a bear market. What's the yield on XLE? 5%. And what did ExxonMobil say in their earnings announcement 2 days ago? They are going to maintain the dividend, full stop. So you put all those things together, you can make money in XLE, and you can make money in ICLN because the trend towards clean energy is manifest and is not going to change and is only going into greater and greater levels of activity. But the real interesting thing is then, okay, you say, I have a position in XLE, I have a position in ICLN, but the real emitter is vehicles, transportation. And so you get to the point where If for Joe Biden, for example, electric vehicles represented 2% of new car sales last year. Yet to Joe Biden's net zero, by 2035, so less than 15 years from now, electric vehicles need to represent 50% of new car sales. So going from 2 to 50, and by the way, China is fully focused on electric vehicles. Europe is increasingly focused on electric vehicles. General Motors. So here's kind of interesting, the old saga, the old line, what's good for GM is good for America, and vice versa. So now General Motors just came out and said, I forget the exact date because it's hard to keep all the dates in line, but within the next 10 years, I think, they are not going to be selling any internal combustion engines. Zero. General Motors. So you need to own electric vehicles too, is kind of the point I'm trying to get to. So then you have, and you have an ETF for that, CARS, KARS. And you have other ETFs, I'm sure, that are somewhat similar. You have an autonomous vehicle ETF, et cetera. You have your stock, bond, commodity alternatives. You have your US, Europe, Asia. You have your tech, financials, energy, industrials, healthcare. And now you have to have thematics. You have to have clean energy. You have to have electric vehicles. You have to have innovation. You have to have fintech. You have to have cyber, etc. The recreating of the portfolio is what's really kind of energizing me, and sizing of all this stuff is really where I'm focusing my attention.
Yeah, it's interesting, the thesis of all these large countries shifting to net zero. People will agree with that. But then when you go down to the next level, that's where it gets interesting. How do you play it exactly? It's not so simple that you just dump all old energy and go into clean energy. There's some nuance there, and there's knock-on effects, transport then. And so then it becomes lots of moving parts. And that's where the challenge is, and to kind of put it in the right position. And then think about things like the dividend yield and things like that, which you can't ignore if we're in an environment of generally low yield. So then there's a lot to kind of think about there.
Well, that's why you need me. That's why TPW Advisory is your go-to source, people.
Yeah. And when you think about these thematics, do you think about them on a global basis, or do you then break them down into regional basis? So for example, in this clean energy example, you look at some US ETFs or the US, then would you then do the same for Europe and the same for China? Or would you think about these themes globally? So it cuts across the regions?
Yeah, I think it starts globally because there is global competition, and it helps me think about, I think globally, but I also think regionally. So this again goes to my tripolar world thinking. For the last decade, I've been thinking in these kind of buckets as well as globally. So I have a great appreciation for what China is doing in electric vehicles, for example, and in battery. I pay very close attention, for example, when the European Union announces, as they did earlier this week, that they are going to provide many billions of dollars of funding to have a European battery production capacity, because they don't want to rely on China and the United States. I pay a lot of attention to words like strategic autonomy, which is what you hear from European policymakers. I pay a lot of attention to self-sufficiency, which is what you hear from Chinese policymakers. And so this is the way to think about the world. We're in a world where, as a result of the last couple of years, there is these regional poles developing. And it's worrisome to me as an American, frankly, because I don't really see that happening in our hemisphere, in the Americas at all. I can make a case that Europe is integrating rapidly and has a real chance to win the 2020 Green Deal, Joint Recovery Fund, joint issuance of debt, joint taxation, soon to be common deposit insurance, cross-border bank M&A, et cetera, et cetera. I can make a great case for what we've done in the US to push China to self-sufficiency in technology and to drive domestic consumption. It's dual circulation strategy. These are responses to the environment that we, the United States, have created in a large way. And so you have got to be involved with China electric vehicles because they dominate the space. Here's a quick little fun stat for you. Out of all the electric charging stations in the world, 90% roughly are in China today. 90%. Okay, so when you think about the future, where's the leadership? And the leadership in things like electric vehicles is right now is a food fight between Tesla and the Chinese, with the Europeans, VW, and others coming up strong. Again, depends on how you can structure your portfolio to incorporate these different things, because you only have 100. Right? You have 100%, and I don't run anything levered, so it's a straight 100% portfolio. And so that's really the question, in the right vehicle, and you spend a lot of time doing that. But I think that's, again, what makes the ETF space so great. I don't necessarily have to think about individual companies and then betting on a company, because you're going with SPACs and the IPOs and COVID speed, you're getting closer and closer to the beginning of that, innovation or cycle, right? Where the early adopters, et cetera, you have the opportunity as an investor to get closer to the beginning, but that means higher risk, obviously, particularly if you go company specific. So I love the fact that I can just do an ETF, and yes, I'm not going to be up 20% in a day, but that's fine. I don't want to be up 20% a day, because I've been around long enough to know that means I'm probably going to be down 25% in 2 weeks. So the ETF vehicle is fantastic for this environment and for expressing thematic investment.
Yeah. And you talked about US leadership. Obviously, we've got a change in the party in power in the US. You have President Biden, you have the Senate as well, controlled by the Democrats. So it's full control, so to speak, although the margins obviously are quite small in the Senate. What does that mean for the US then?
That's an excellent question. It's one I don't think people are paying anywhere near enough attention to. I think it's absolutely significant, and believe that we are at the beginnings of a regime shift away from 40 years of Republican-led thinking that government is bad, big government is bad, and we need to shrink government. And I actually, in my musings, I do a Friday musings piece, meant to be kind of the distillation of my thinking every week, comes out on Fridays. And the last one was titled, "I'm from the government and I'm here to help," which is the words that Ronald Reagan in the early 80s said the 9 most terrifying words in the English language were, "I'm from the government and I'm here to help." So you take that as your starting point, and you end up with the Trump administration, whose stated agenda was the deconstruction of the administrative state, right? Steve Bannon's famous quote when he was the strategist for Trump as he was entering office: the deconstruction of the administrative state. That is the logical culmination of 40 years of efforts to make the point that government is bad and we shouldn't pay taxes. So we've ended that. Can't go any worse. And that deconstruction, by the way, there was a lot of it, and it resulted in COVID and the just pathetic response, in my view, to COVID. And so now we are switching gears. The American people have said, no, we don't want more of that. We want to go to government is good. And Joe Biden and his team are deep believers in government, A, deeply experienced in governing, B, and have the experience of the Obama administration, where many of them worked, C, where they went too small and failed to really jumpstart the economy, and thus kind of created or exacerbated the populist mentality, which has developed in the US political system, to a point where we have one of our two parties that arguably still is not willing to say that Joe Biden won the election cleanly and fairly. So this, to me, means that there's a huge opportunity for Joe Biden and his team to go big, to get a COVID win, to unleash an economic boom, to set up for victory politically in 2022 and 2024, which will lead to a period where government is good, gets ingrained, and they have every opportunity to do so because we have record cheap money, can't get, and not had cheaper money virtually in the history of the United States, to show and prove that government is good. And so I think that's what we're going to see from the Biden administration. We're going to see an activist government, which leads to policy-driven markets, which leads to thematic opportunity sets. So when you think about this, it's all kind of coming, a lot of things are coming together in a very powerful fashion. But the shift from government is bad to activist government is good is probably a 30, could be a 10 to 20 to 30 to 40 year move. And so I think it's, and to me as an American, frankly, it's great. And not because I'm a Democrat or an independent or Republican. It's because when I look at the tripolar world, as I said, kind of to the outset of our conversation, I struggle to see where the Americas are. I can see Asia moving aggressively, led by China, the consumption center for the world. I can see Europe integrating, being the normative rule-making power, regulatory agent in tech and climate. I don't see what the role of the Americas is. And I'm hopeful that breaking the gridlock of the last couple of years where we've not really been able to get anything done in this country. And I'll just give you one quick illustration of that point. The World Innovation Rankings just came out. The United States ranked 11th. Less than a decade ago, the US ranked first. So we've gone from number 1 in world innovation to number 11. And if we're accepting of the idea that innovation and technology in climate, in fintech, et cetera, is going to be what drives us forward, going from first to 11th in less than a decade is a very, very bad sign.
And who's at the top, by the way?
I believe South Korea is first. And there's a number of European countries, which is interesting, because Europe has no, publicly traded technology.
No. And just going back to your thesis on the more activist government, that's really quite compelling the way you express it. The two counters people have raised to that type of view is, number one, on the activist side, that the Democrats will overregulate. They'll regulate the tech guys, and that will be really problematic for the tech stocks. And then on the other side, on the fiscal side, say, obviously there's a big bill now, and if they use the budget reconciliation process, they could maybe pass something close to 1.5, maybe even 2. But then after that, that's one and done. It will be hard to push something else through with the filibuster, or, there's a chance for a second reconciliation. Theoretically, you could use that. And so there's kind of a view on the fiscal side that it's a big now, but can they really, push more stuff through with the filibuster as a constraint on them? So how do you think about those two, the regulation side and the issue of the filibuster and just gridlock?
Right. Well, it gives me an opportunity to bring up one of my other pet phrases of the last couple of months, which is that a vaccine and rising rates are kryptonite for big cap tech. And so the regulatory issue is most likely going to be faced by the technology companies, particularly the big platform companies. And I believe that there's antitrust legislation that's going to be presented perhaps even today, but very soon. And I think this is an issue that, after what's happened to our political system and the assault on the Capitol building, I think there's great appetite to understand exactly how social media and some of the platforms are affecting our social environment and our democracy. So, I'm not an expert in that space, but I do think that the regulatory issues will be faced from an investment point of view most clearly by big cap tech, which I think is already unattractive for the reasons I mentioned. A vaccine kills the work from home thesis. Rising rates affects the cash flow valuation. And you can see it already. Big cap tech effectively peaked months ago. So I argue that you shouldn't think about FAANG, you should think about ARC and things of this nature as a quick shorthand.
And I guess what you're saying there almost is, I suppose we've got used to in the last 10 to 20 years that innovation equals big tech, but that's not really true. So that heuristic isn't correct.
That's 100% a great way to think about it. And as I spoke earlier, we're getting closer and closer to the early adopter stage of tech as investors, public market investors, through IPOs and SPAC. And I'll give you another little tidbit. And I love these, little tidbits because they kind of keep me centered. When the term tech unicorn was introduced, literally less than a decade ago, there were 47 unicorns. Today, over 500. 500 private tech companies around the world that are valued at over $1 billion. So we're going to see a lot of those companies come to the public markets, and we're going to get a chance as investors to participate in them. And then through vehicles like, for example, EMQQ, which is a great emerging market internet and e-commerce ETF, you can get exposure to these vehicles, to these new IPOs as they come public around the world in one vehicle. I mean, you can't get much better than that. So, and the other side of the regulatory is climate. And there, I think people are very much accepting of the idea that we need to, have higher mileage. We need to have electric buses, et cetera, et cetera. So I don't really see that as a huge issue. I do think that the fiscal side is more interesting. And I believe, as I said earlier, that the Biden economics team understands that in 2009, 2010, they did not go big enough. So I think Joe Biden, his temperament, he's a moderate, but his physical temperament, his personal temperament is very calm and level, which is fantastic after what we've dealt with in the last 4 years in the United States. So that's fantastic. And yet he also has had a real nose for the center of his party. And so he understands that the party has moved to the left. And the way somebody put it, left of Obama, right of Elizabeth Warren. That's where you see the Biden administration. And here's the tagline that I think expresses the view. Investing in equity is good for economic growth. Equity being kind of dealing with racial disparities and inequality, right? Which is a huge issue in our country because 10 years of monetary policy dealing with our issues has meant that, guys like you and me have done really, really well. But people who don't own, who don't trade markets for a living or don't have a big investment nest egg or don't own their house, because to be fair, household net worth in the US is at an all-time high because you've got a stock market at an all-time high, home prices at all-time highs. So yes, but if you're not a homeowner with a portfolio of financial assets, you haven't done well. And so investing in equity is good for economic growth. And I believe that President Biden is opening himself up to the Republicans. Let's hear your plan. Their plan was $600 billion, a third of what he's suggesting. That's a non-starter. That's going to go absolutely nowhere. So they will, I believe, if necessary, pass the bill by reconciliation, and then they will come back and I believe be even stronger a year from now. See, the idea that the administration has to do everything in its first year, I think is incorrect in the current environment, because all the Biden administration has to do to declare to be a winner is to deal with COVID and get people vaccinated. Then the economy booms. And I think in 2021, 2022, there'll be every opportunity to come back with a big infrastructure and climate program and bill and budget that people will be very much embracing of. So I don't see it as a one and done. I do expect it to be somewhere around $1.5 trillion for this first bill, the Rescue Act. And then I think the infrastructure and climate plan will come later. It will be after these two successes. And I think it will find favor with the American people and with investors.
And, I'm just thinking, it's a very compelling story that you're telling. And in terms of risks to the view, one common one that a lot of people are concerned about is what happens if we do get this rise in bond yields. You said that we could see a move up towards 150, 175, even 2. Would that derail markets and your thesis? And the other one, I suppose, has been brewing for a while now, some kind of conflict between the US and China. So, while, the trade war was kind of more of a Trump issue, the tech war between US and China is more of an establishment. It's not a Trump thing per se. And so you could see clashes between the US and China there. So in terms of those two as risks, so, a rise in bond yields, because could that be kind of something that could derail this boom? And then the other one's US-China tensions escalating.
Yeah, no, great things to highlight and to think about. And certainly have thought about both of them quite a bit. So I don't worry about rising rates derailing the stock market in the US. I do think at the margin, it means the US is likely to underperform because of the effect on the big cap tech, which, depending on how you cut it, is anywhere from 25 to 40% of the US equity market. So one of the things I've done in the last 6 months, as an example, is I own a core S&P holding is an equal weighted S&P. It's not the market cap weighted. And that's done very, very well. And I think it will continue to do very, very well.
What's the ETF for that, by the way? Because I know you're the expert here.
RSP, Robert Sam Paul. Yeah, no, it's been a great vehicle and has massively outperformed the S&P over the last several months, and I think will continue to do so. So to me, rising rates, getting to 1.75%, 2% by the end of the year, because the economy is booming, is not going to derail the stock market. And I think where people are wrong is this idea that the Fed is going to get really worried about this. That's really where the action would be, where if the Fed were to come out and say, hey, we can't have this, rates up at this level, that's not a good thing. I don't think the Fed does much of anything, because I think the Fed understands that, first of all, we will have some inflation, so maybe backtrack a bit and say in the next quarter or two, people should get ready for headline inflation prints year over year of 3 to 4%. Because remember, a year ago, inflation was negative, -0.8, -1% in February, March, April of 2020. So as those numbers drop out, you're going to see big prints on the headline. Now, obviously, you have to look at core, you have to look at the PCE deflator, the things that the Fed cares more about, and those are less volatile. But you even have things I just noticed the other day in Q4, another little tidbit, asking rents in the US, asking rents up 18% year over year. Signed rents in Manhattan, people saying the city is dead. Signed rents, leases in Manhattan in December, up 94% year over year. 94% signed leases year over year in December. So we're not talking about the bottom in March. We're talking about when things were quote unquote good. So rents are, and I say that because rents are a big part of the CPI basket in the US. So my point would be transitory inflation spike in the middle of the year, ebbing thereafter, Fed sees through it, rates rise, real rates, importantly for financial assets like stocks, real rates go more negative, thus potentially being constructive for crypto, for gold, things of this nature. So again, reason to think about having some crypto in your portfolio is the stable asset nature of it and what could be perceived to be an inflationary environment. But so I don't really see the Fed acting. I don't see 2% or 1.75. If we go there, we've gone from 90 to 1.15% in the 10-year US Treasury. We'll go to from 1.15 to 1.3, 1.4 in the next couple of months, and so on and so forth. I do see it, though, again, as an important support for the idea of rotating away from US equity to the non-US equity markets, which are cyclical value plays like Europe, like Japan, et cetera, because that don't have that tech exposure. So to me, that it all fits very nicely with US relative underperformer. Not collapsing because those tech companies, as we just saw this week, making absolute tons of money. So they're not going to collapse. This is not a 2000 environment by any stretch, but they're going to underperform. And then to your second point about the US and China, Splinternet is for real, without a doubt. As I said earlier, we have told the Chinese through our actions in the last year or two that they cannot depend on us to buy key things for their own development and forward movement as a country. So that's when you do that, the people say, okay, well, we have to have it, so we got to make it ourselves, and they will, and they are. And so you're going to have a separate tech stack in China, a separate tech stack in the United States. And by the way, things like semiconductor chip shortages, President Trump being booted from social media, these reinforce the idea of we want to control our own tech stack, right? And China has its great firewall. They're already there in the censoring of things. But, semiconductor production, that's a huge issue, right? And so in Europe, which I think is really fascinating, is that Europe sits in the middle, and they're a big market. So people want to play and participate and sell into that market. So they do have the chance to be the normative or rule-making power in tech and in climate. And I think that's going to be where they play. And they're going to be able to tax on that basis, common taxation, digital and climate. And that's going to help develop the integration that I spoke of earlier. So that's how I see it playing out. I don't see, armed conflict. I think that's absolutely, nobody has the appetite for that. I do think that it's interesting about Taiwan, because you could argue that China has clearly made a move on establishing its dominance and day-to-day control on Hong Kong. And you could argue that the next iteration of that is Taiwan. And you could then say, as a counter to that, that the fact that Taiwan is the world's, semiconductor chip platform probably protects it, because nobody can afford to have that production significantly imperiled. And so to me, that is actually, it means you want to, probably one of the ETFs that I like a lot is EEMA for Asian exposure. It's 75% China, Taiwan, and South Korea. So it really plays that tech hardware as well as software and social media angle. And so I don't see US and China fighting over Taiwan at all. I think China wants to increase its domestic demand through its dual circulation, establish tech self-sufficiency. And by the way, Bilal, as you know, a foreign FX guy and an Asian guy, China has the world's highest yielding government debt, right? 3% plus, and an appreciating currency. And I saw where foreign purchases of China debt in January were a record. And so, the financial investor community is only wanting to get more of China. And China itself only wants to, investors there want to be able to globalize their portfolios. So I think there is a lot of fear about the US-China. I would flip it and say that there's even an equal, if not better, chance that in the next couple of years, we see much more of the internationalization of the renminbi to offset the inflows. They're going to have to allow outflows. And you have, the last thing I'll say on this, and it's true for Europe as well, is that you do see a movement towards digital coins in China and in Europe, in part to get away from the financial sanctions that the US has been imposing on people like in Iran, which really upset the Europeans. And so again, it's an example of kind of US overreach in the last couple of years that is backlashing, creating things that we would really rather not see, because the US has been a huge beneficiary of the dominance of the dollar. And things like digital coins start to set up the framework for that dominance to dissipate. And that's very much a problem potentially down the road. But I'm relatively constructive on US-China relations and don't see, I think the Biden administration wants to do the things I mentioned: beat COVID, economic boom, focus on inequality. By the way, interesting, ideological opposites, US and China, both focused on the working classes and both focused on tech antitrust. So maybe it's more things unite them than actually separate them if you get beyond the headlines.
Yeah, no, that's very good sort of points there. Well, I think we've covered a lot about markets, so maybe let's go down to some more personal questions. One question I like to ask all my guests is how you manage your research and information flow, because obviously we're inundated with information, data, research, and so on. I mean, how do you cope with it all? What's your system?
Well, we talked about the key drivers, right? The first is that tripolar world thesis I've developed over the last decade, which I've updated as recently as a year ago. That's really the framework through which I view everything. And then underneath that is that global risk nexus, GRN, which looks again at health, economics, politics, policy, and markets in each region and globally. And that is a great kind of construct to keep everything in their place and to make sure that we don't miss, or I don't miss things in any kind of meaningful way. I would say that I'm a big reader, always read, that's my thing. And having been in the business a long time, I kind of know who to read, which is very, very important. I have my people in each area of the world and in each bucket of the multi-asset space who I've read for years. And I know when to read them. I know their biases. That's very important to reduce the reading too much stuff, extraneous stuff. The other thing is that, again, having a lot of experience in the market, I have a network of people that I listen to and can reach out to on issues that I'm not expert on. And I'll give you one illustration. As a former Morgan Stanley macro guy, we have a group of us, about a half a dozen people, that we get together once a month on a phone call. And these are all highly successful in very significant positions in the US and in Europe that are active in the markets on the buy and sell side. And we kick it around, just as you were mentioning, you do yourself for the macro Hive. So I know you are a big believer in that. And then last I'd say is I'm a very disciplined person and have been doing this for a long, long time. So have been writing, I started writing once a week at Morgan Stanley in 1995 and pretty much have been doing it ever since. I think I've gotten better at it. So my musings now are, anywhere from 500 to 800 words and are really a distillation of my best thinking. And so I take those, and when I do my monthly, because that's the other thing, I do a monthly. Here's an illustration of how I work. I keep my notes from my musing, put them down every Friday. When it's time to write my monthly, I take the musings, the last 3 or 4 that I've done, and read them over to make sure I'm not missing anything, and then make the leap to writing the monthly, as opposed to having to go through all the notes that I've taken over the last month, which is what I used to do, back in the day. So it's like leveraging, like the notes I made for our conversation today, or the notes I made for going on Bloomberg last week. Those things are then stepping stones, because I'm a big believer that you have to focus forward. I really don't spend a lot of time with people who want to tell me what happened, because that's useless to me. I'm much more interested in what's going to happen. And so I spend my time, I like to say, kind of trying to peer into the near future and get the outlines of how things are going to be, and understand that I'm going to be wrong because I'm thinking about the future. But as the points I made to you very early on, the world we're going into has not been seen by virtually anyone investing today. So I think all of us have the obligation to think forward. And the folks who can do that with some success, and I've been trying to do it for 25, 30 years on a global multi-asset basis, I think those are the ones who are going to be able to, who should be your guideposts to pay attention to. So if you read my stuff, you realize it's very little about what happened. It's much more about what is happening and what I think it means for the future.
Yeah, no, that's great. And you mentioned you like reading. Are there any books that have really influenced you a lot in terms of your thinking?
You were kind enough to tell me you were going to ask me that question. So I was able to go to my library last night and take a look at my collection. I have a pretty decent library. So I'd mention a couple. Anything by Peter Bernstein, Against the Gods, The Story of Risk, absolutely crucial to understand. And to me, it's very, very appropriate today, because as I said, we have a chunk of the American electorate that doesn't seem to believe in the truth, or doesn't even really know what the truth is, which is staggering to me, but is true and is very, very worrisome. So Against the Gods, Capital Ideas Evolving, both by Bernstein. I think you have to understand China. I read a lot about China. I subscribe to a number of things that give me insight, but one book that I read recently that I thought was very good was Age of Ambition by Evan Osnos, O-S-N-O-S, very good. The Devil Take the Hindmost is a popular one by Edward Chancellor. Again, story of kind of markets going back, more historical. And then 2 kind of more current ones on the US, well, not actually current, one's current, The Unwinding by George Packer. Really the story of what's gone on in America for the last couple of years. So if you're trying to understand why half the country doesn't recognize that Biden is the president and won fairly, The Great Unwinding helps one to understand that. And then The Great Risk Shift by a guy named Jacob Hacker is really, really good at understanding, again, kind of why many people feel the way they do, because much of the issues around healthcare, retirement, etc., have been pushed back to the individual from the company in the last 20 or 30 years in the United States. And the government, where in many countries steps in, particularly in Europe, the government hasn't really stepped in the United States. And so, issues like going bankrupt because of medical concerns, or issues around inequality and wealth, and the fact that the minimum wage hasn't been raised in 30 or 40 years, stuff like that. The Great Risk Shift helps you understand that. I feel like I read widely. I like to read about important countries and important regions, so I spend time reading about Europe and Asia, as well as the United States and Latin America. And to me, it's really an opportunity to let things kind of digest and find the little tidbits that help you kind of tell the story and give you a guidepost. Because being a macro guy, I think, is almost like being a guide and like trying to find your way through a forest. And there's, it's dark, it's impenetrable, the trail is unclear, the sign markers are faded, can't see them. I used to do a lot of climbing. So, those types of things. And reading to me helps me both understand and appreciate and think differently. So I like to read not just financial stuff, as I illustrate.
Yeah, that's a great list of books. Some of them I've read, some of them I haven't, so I'll make sure to read them. So I think maybe we can wrap up now, but before we do, how can people get in touch with you?
Yes, definitely. Launching a new company. I'm very interested for people to get in touch with me. My website is www.pelosky.com, Pelosky. My email is jpelosky@pelosky.com. And I'm on Twitter and LinkedIn, both under J. Pelosky. So yes, feel free to reach out. My website has all my media and my musings and other things on it. You can get a sense for the tripolar world and the global risk nexus. All of those things are available to you. And I appreciate the opportunity to speak today with you and your audience. And congratulations on all your success at Macro Hive. And hopefully we can continue to do some things together.
Yeah, absolutely. Yeah, I'll make sure to include all your contact details on the show notes. And I do urge everybody to have a look at the site and subscribe to whatever options there are. Make sure you listeners do that. So with that, thanks a lot, Jay. It was an excellent conversation, very inspiring in many ways. It was great to chat to you.
Thank you, Bilal. And thank you again for the opportunity. You asked some great questions, and good luck with continued success.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a member to our research at macrohive.com. We'll be back soon, so tune in then.